Yo, what's up YouTube? Welcome back to the channel for another video. Today we're going to go over my trades, my NASDAQ trades for today for January the 21st and go over the psychology of hedging, most importantly. What it is and how you should take advantage of it and when to do it. So usually I don't personally hedge that much. It's kind of, I don't want to say against my rules, but I don't like to hedge because I feel like it puts my capital too much at risk. I like to take my prime optimal setups and then just take them as they are and move on if I lose. But today it made sense to hedge, and I'll show you guys why as I get into these trades. So today I was looking at the NASDAQ as the only asset I trade for now, and I was looking at the AM session here, and I see that I get a big buy side sweep of liquidity here for the AM session, go over my first trade. And I'm looking at that sweep of liquidity here, but I'm also seeing that price is in a huge uptrend for the last few days. You guys could ignore the lines here. I was just marking up some wins and losses from a previous backtesting video you guys can go check out. And I'm looking at, it's in a clear uptrend. It's been trending up for the last 5 or 6 days. And we get to today, and I see it swept some more buy side liquidity here, but it did have a small sweep of liquidity of sell side liquidity here, pre-market, pre-New Year session at least. But I wasn't really focused on that. I was looking at this here because that's when I started to trade around pre-market session at like 8:50, 8:45-ish. And I was looking at this buy here. I'm looking at my entry model, and it presented itself, and I was a little cautious. But I'm testing out or trying to think about refining my trading style. So I was thinking about, okay, it's still valid to take this buy because it's in an uptrend, and my entry model is being presented. It's here. And it is a buy. It's what the correct buy is. Only thing I was a little hesitant about is because it just swept buy side liquidity, and its price is in pretty much a premium, so it's not ideal to buy up this high. But I was hoping it'd be like a cheeky trade to where price might go wick here and then go up a little bit to sweep a little more liquidity that's up here. I'll go back to that in a second. Or I was hoping maybe it would tag me in this trade and then consolidate a little bit, and then when 9:30 came, it would spike up a little bit and wick up and hit my take profit, then reverse down and do whatever it's going to do for the rest of the day. But that didn't happen, so I was hoping for a really quick trade, maybe like a tag in the wick before the market started, so I could come in and sweep this liquidity up here a little further to the left from yesterday. So I'm going to push a bit higher, but that didn't happen, so that trade ended up being a loser. This buy did. And that's fine. So it went with my rules. It wasn't the most ideal just because of how high it was, and then price sweeping the buy side liquidity right before it forming or during it forming. So I was in the process or the mindset of, okay, this might be the perfect time to sell. It was a valid trade. It was a valid loss, but I thought about just hedging. I usually don't do it, but it's like this is the prime time to do it. So with hedging, you want to make sure you have a plan to hedge. Like, you need to know you're going to hedge before your trade is going to lose. I knew that this is a prime time to go and look for my sell and have a sell position here. So I was already prepared and planning for that. I didn't just react because I had a loss and just flipped and bought and sold. I gave a valid reason for me to sell here, and I knew that before I entered the sell. So you want to make sure you always have a plan before you hedge. You're not just doing it in reaction or emotionally doing it. So I looked at this. I saw that it was for the sell. I saw that there was the buy side liquidity that was on my side. I know it's in an uptrend, but I saw this buy side liquidity here that it just swept. Then it gave me a valid entry model for me to sell as well. And then it was also in a price here in a premium, so I knew that it was a valid entry for me to sell. And just knowing that price moves in waves, basically. So waves of like 3, but when it's in trend, but when it's counter trend, probably moves like waves of like 1 or 2. So I was looking for at least one quick push down to also sweep down to this sell side liquidity, at least here and here, but it ended up pushing down a little further as well. And that we'll go into the next trade for that, how that worked out. And that ended up working out in my favor because I knew that this trade was probably going to be the reversal or at least a pullback or cause a pullback for price. So it gave a valid sell model, and I took the hedge pretty much right after, like a minute after this formed. A minute or two after this form, and it went through, and it was a valid setup. Usually what I would do in normal trading is I'd wait for this to set up and then take the continuation, and that would basically lead to this trade. But the reason I felt comfortable taking this was just because it was a pretty prime setup with the liquidity being swept just here, then the loss, and then it being a pretty clean model. So I took it because of a few things. When you're hedging, you want to make sure it's very planned, it's very clean, and you want to do it when you're either really fresh on the week, like it's really new. It's my first trading day because yesterday was MLK Day and Inauguration Day. So you want to make sure you're not down too much equity whenever you're hedging, or you want to make sure you're pretty early in the week, like you're not using too much capital, you're not risking too much capital and just digging yourself into a further hole. So I had a little equity to at least play with here, and I felt comfortable taking this trade because it's only the second trade of the week for me. And so I just took it and I let it hold and it hit take profit, and that was the second trade for me, and it went through. Then that would be an indicator that okay, price was pushed down a little more, and then it pushed down and swept this liquidity. But in my eyes, it's still valid to look for a sell here, just because I'm looking for a continuation off this. And so I took this sell, and even though this also another confluence, this is not the most prime sell setup, just because it just swept this buy side liquidity, and it's also in an uptrend prices, at least in the M15 right now. I just took it, but it's still valid to take it. But I in my head, I knew that it wasn't the most prime setup. So once I saw that it was consolidating a little bit, and then it dropped, and then reversed, I knew that it might be an opportunity to go and catch the buy move, because I'm mostly looking for the buy here anyways, because it just swept liquidity and I'm in an uptrend already. So I was looking for the buy ideally anyways. It was very possible that this could have been, though, like a selling day or just a day when price wants to reverse the trend. So it could have been just pushing down and just kept pushing down and plummeting down. You might have seen this a big day where it just reversed. But that didn't happen. So once this happened, always want to be present and focusing in the markets and focusing on what's going on right in front of you. It is not worried about, okay, I'm in this trade, it has to sell. It does not have to do anything. You just want to be worried about what is happening, just be reacting constantly. So I had a plan. So I figured if it gives a really clean setup, I would take this buy, because the buy is more ideal, more prime here because it's in an uptrend. And I'm also partly testing how I want to refine my strategy. If I want to just go forward, just taking buys or taking sells, depending on the trend, and it's in an uptrend. So right now, if I was to refine my strategy to that alone, I'd be looking for buys only. And it gave us pretty clean setup, and it's a little more clean on I'll show you the 15-minute liquidity sweep. So I swept this liquidity, and then I also swept this liquidity here as well. And then you see on the 3-minute, it was pretty much a cleaner setup for my entry model. And then it was a little jumbled on the 1 minute, but it still was there, and I took advantage of it on the 1 minute. Gave the entry model. I set a little riskier take profit, or at least closer stop loss, just for a little more easier risk to reward. And it went through, so I'm just playing it out and showing you guys how it went through. And I'm actually holding a small piece of this position based off this larger trade range, and take profit should be up here somewhere. So we'll see if it goes or not. I've already closed like 99% of the position though. So yes, I'm holding that through, and we'll see what happens with that. But the psychology is that you want to make sure you're going into a hedge with a plan. You're not just doing that reactively. Like I knew way before this hit stop loss, because this hedge literally happened while this sell was still active. So it's different instances. So this hedge happened after this trade hit stop loss, and this hedge happened while this trade was still active. So when you're hedging, you kind of almost know before you're taking your first position. So I kind of almost knew before I took this sell that a buy was probable, or at least could happen. I was ready to take it if it did happen. So you kind of almost want to know you're going to hedge before you're hedging. It's not something you want to just jump into randomly or rush into. So it's not like if you were doing like a random trade, like I took a buy here, oh it lost, so it must be ready to sell. That's not the logic behind it. You want to make sure you have rules and risk behind it and some steps into it and understand why you're hedging. So what hedging is basically you're just trying to protect the position by taking an offsetting one, but you want to make sure it's very calculated. So in this instance, my hedges were very clean and valid trades where I was able to just take them and hold them, and they went through full take profit. And that's just because they were really prime setups that also just went kind of with where the market was doing. Like with this one, it was in a prime position to do a sweep of liquidity, then pull back down and reverse for a quick sell, and that was a valid trade. And this one, this hedge is going with the market trend, and it gave a really good setup on a higher time frame and the lower time frame as well. and it gave us sweep liquidity here. So it's really a prime setup as well. But with hedging, you don't always have to look to look to have a banger trade or look to have the biggest take profit or biggest profit from that trade. You're looking to try and cover your loss of the previous trade. So it depends on your strategy and how you want to go about it, because you can just take a hedge, a valid hedge, and you can say, okay, I've covered my loss from the previous trade. I can close this trade out early and I'm fine with it and move on to the next trade. So I could have just said, okay, I covered this loss. I lost that, let's say 1% of it on this trade of equity. So I'll say, okay, I'll cover this trade and I'll close it out here. It's a quick trade, but I close it out here and just move on to the next trade. But since it's such a valid trade and overall the time frame looks like it's going with it, it made sense for me to at least hold this trade. That probably would have been more valid to hold for this trade here, or to close early for this trade here, because it's going a little bit against the trend and what I'm overall looking for, because I was overall looking for the day to buy. So this could have been more of one of those quick trades. You say, okay, I'm going to just cover this loss and then get out of the market. So it's all down to a plan. You want to make sure you have rules and reasons and plans about why you're going to hedge, if it makes sense with your strategy. You're not just going to want to jump in randomly and say, okay, I'm going to sell here just because I lost this buy, or I'm going to buy here just because I lost this sell. You want to make sure there's a lot of confluences that go with it, and you understand what you're doing with the hedge. You're not just sitting there trying to milk the market or have a crazy trade just trying to recover some of your capital and equity. It's not revenge trading. It's a way to try to protect yourself and offset a trade you just had. Because it could have been your first trade, it could have been a rush trade. That's possible, but you want to make sure it's a planned thing where you said, okay, I'm having logic with this first trade, but maybe it didn't make sense. Maybe I have a little more logic in this second trade where, okay, it makes sense. Okay, price might not do this, so I'm prepared. If it loses or this forms, I'll take this trade, and it'll be a calculated risk. Like I said, you want to make sure you want to either make sure you're doing it with beginning of week where your equity is really fresh, and you want to make sure you're doing it with a little more profit and equity that is in profit, because you don't want to start hedging and doing a lot of hedge because you're putting extra capital at risk if you're already down in the negative for the week. So you should just do it whenever you're either at break even for the week or you're in profit really. So that's what I would recommend, and it made sense to do it today, and it played out in my favor. I usually don't do it, but yeah, it worked out in my favor today. It took a few more trades than I would like because I took 4 today. But that's okay. I'm still testing out how I'm refining it, and it made sense. Everything was with my confluences and rules. But yeah, if I'm looking at my refining spot now, and if I didn't want to, or if I was refining how I might trade in the future, I probably just would have took 1 or 2 trades today. But it ended up working out, so it's not so bad hedging as long as those rules make sense, and what here they did for me. So yeah, I'll wrap it up here. Just give you guys a quick little insight on what hedging is. You're just trying to protect your capital, and you don't want to over leverage. It's possible. Here's another quick tip. You might not even want to risk the same amount you would risk on a regular trade on a hedge. You might just want to risk 0.5% because you're just trying to cover a little bit of a loss, or at least if not a full loss and like half of a loss. You're just kind of cover some part of your account there. But you're doing it very calculated and precise. You're not rushing into it. You should know almost before you enter in your first trade if you're going to hedge or not, basically. I knew before this trade went through and before I lost it, I was probably going to hedge and look for a sell here just because of how valid it was. You should also probably know, like, okay, this might lose because it's not the most ideal in this confluence. And this one as well. I knew this first trade or the second trade or third trade might lose because it wasn't the most ideal, and I'm prepared to buy. That's the overall bias for the day. So just make sure you're doing it at the proper time of the week, if you're up or not, if you're making sure you're not risking too much equity or doing it while you're in a hole, making sure it's calculated, it's going with your rules and has a lot of confluences with it, and making sure you're not expecting too much from the hedge. And you don't even have to do it often. You can do it once every week, once every 2 weeks. I don't do it that often myself. It just happened to make sense today because these plays were pretty clean and they went with overall bias for the day with what I was looking for. So with that, I'll wrap it up here. Be sure to check out some more videos, like and subscribe, and stay tuned for the next posting.